circumstances, the MPC decided to remain watchful of the evolving outlook in the coming months. Keeping in view the prevailing inflation and growth conditions and the outlook, the MPC considered it appropriate to change the stance to neutral and to remain, I repeat, and to remain unambiguously focused on a durable alignment of inflation with the target, while of course supporting growth. I would now turn to an assessment of the growth and inflation situation. First, let me talk in brief about the global growth conditions. The global economy has remained resilient since the last meeting of the MPC in August. Although downside risks from increasingly intense geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and elevated public debt continue to play out. Manufacturing is showing signs of slowdown while services activity is holding up. World trade is exhibiting improvement. Inflation is softening, supported by lower energy prices. Growing divergence in inflation growth dynamics across countries has resulted in varying monetary policy responses. Let me now turn to domestic growth. Real GDP grew by 6.7% in the first quarter of this financial year, that is 24-25. And this was led by a revival in private consumption and improvement in investment. The share of investment in GDP reached its highest level since 2012-13. Government expenditure, on the other hand, contracted during the first quarter. On the supply side, gross value added, that is GVA, expanded by 6.8%, surpassing the GDP growth, aided by strong industrial and services sector activities. High-frequency indicators available so far suggest that domestic economic activity continues to be steady. The main components from the supply side, that is agriculture, manufacturing, and services, they remain resilient. Agricultural growth has been supported by above-normal southwest monsoon rainfall and better kharif sowing. Higher reservoir levels with good moisture conditions of soil augur well for the ensuing Rabi crop. Manufacturing activity is gaining on the back of improving domestic demand, lower input costs, and supportive policy environment from the government. 8 core industries output fell by 1.8% in August on a high base. Excess rainfall also dampened the production in certain sectors such as electricity, coal, and cement in August. The Purchasing Managers Index, that is PMI for manufacturing, at 56.5 for September remained elevated. The services sector continues to grow at a strong pace. PMI services at 57.7 in September indicates robust expansion.